Okay, are you able to see the screen? Hello, is it visible?
Yes, sir.
Okay. So we stopped at debt equity ratio, I think. We completed a debt equity ratio, isn't it? This one. So the relationship between debt and equity ratio. Equity, owners contribution, and debt means outsiders. So how much owners and how much equity owners outsiders are contributed. So the debt and equity. Long-term loans are taken in debt. Equity means owners fund. Share capital, reserves, profit and loss account balance, and all those things were taken. So in this problem, calculate debt equity ratio from the following information: share capital, secured premium reserve, securities premium reserve, negative balance. So this is a negative balance. So you have to subtract from the above total. Then long-term borrowings, debt, non-current asset and current asset. No need of that. So now the debt is only 20 lakhs 70,000. So long-term borrowings only the debt. And in case of owners, share capital, security premium, and negative balance is subtracted. Is subtracted. If it is positive balance, we have to add. If it is negative balance, we have to subtract. Or it may be expressed as profit loss. If it is profit, add. Loss means subtract. If it is mentioned in accounting terminology, credit balance means profit, debit balance means loss. Profit and loss account credit balance means profit. Profit and loss account is a nominal account. Debit all expenses and losses. So debit means loss and expenses. So loss. Credit means all income and gain. So the credit balance means income, profit. So the sum of the owner's fund is 17 lakhs 25,000. So loan is 20 lakhs 70,000 and owner's fund is 1725. So 1.2 is to 1. 1.2 is to 1. So it is up to 50% more is acceptable. So the financial position of the firm is so not so good. It's okay. So this up to this we did, I think. Yes, this one also I explained in the last class. Yes, are you feel comfort how it is? It is easy, na? Very simple problems, na? Hello, are you listening? Hello, hello.
Yes, sir.
Is it clear? Are you able to listen?
Yes, sir.
Here. Okay. Are you able to follow?
Yes, sir.
Calculate debt to equity ratio from the following balance of company. So in this, indirectly they had given total assets and current liability, non-current liability, current liability. Non-current liability is a debt. So current liability is short-term debt. So this is long-term debt. Now the total assets is given. Now you have to find out what is that basing on capital plus liability is equal to asset. So from this assets, total assets, if you subtract liability, short term and long term, then you will get owner's fund, then you will get owner's fund. So total assets minus non-current liability, non-current current liability, so then it comes to 8 lakhs. So debt equity ratio is 12 lakhs by 8 lakhs, 1.5 is to 1. So this is about debt equity ratio. Next, now we are going to see the relationship between total assets to debt. So how much assets we are having and what is our debt. So we know both the things. Total asset means balance sheet, asset side. In balance sheet, asset side. So you will have fixed assets. So these fixed assets are tangible, intangible assets, and investments. So these investments are short-term, long-term investments, and loans and advances, current assets. So by adding all these things, we will get total assets. Here, capital, reserves and surplus, long-term loan, and current liability. This is long-term loans. So the sum of this and the debt. So how much our assets and how much our debt, whether our assets are more than the debt. So total assets, it includes non-current, tangible, intangible assets, non-current investment, long-term and advances, long-term loans and advances, current assets, current investments, inventories. So current assets, current investment, inventories, trade receivable, cash, cash equivalents, all this we had seen. Long-term borrowings and long-term provisions, debt. So higher the ratio implies profitability situation of the business concern is good. So how much maximum assets are more than the debt is indicating the good health of the organization. Calculate the total assets to debt ratio from the following balance. So if the question is given in this way, any ratio one can able to calculate easily. Why? Because this is owner's fund. So share capital and reserves and surplus, the sum of that. This is long-term liability, non-current liability or long-term liability debt. This is short-term liability, current liability. Here this is fixed assets, tangible, intangible. Non-current investment. Mm, this is non-current investment, 7,50,000. Then all these current assets. So current assets to current liability. So here excluding inventory to current asset, current liability is quick asset, quick, and debt to equity, and debt to total assets, equity to total assets. So everything we are able to solve if it is given in this way. So already it is grouped in the balance sheet itself. So normally we will not get in this way. So here total assets to debt. Now the total assets is sum of this 66. Debt means 22 lakhs 50,000, 4 lakh 50,000. Long term borrowings, long term provision. So total assets by debt, total assets, non-current assets and current assets. So the total we have taken all assets, tangible assets, intangible asset, non-current investment, current investment, inventory, trade receivable, cash, cash equivalents, long-term borrowings, long-term provisions. Still, long-term debt, long-term borrowings and provision. It comes to 27 lakhs. Still 6 lakhs by 27 lakhs. 66 lakhs by 27 lakhs. So 2.44 is to 1. 2.44 is to 1. So the assets are more double than 2.5 times of the liability. So the financial position of the firm is good. financial position of the firm is good. The next one, So in this way, you will find the question, not in that manner. So calculate the total assets to debt ratio. Calculate total assets to debt ratio. So the share capital, long-term loans. So this is debt, long-term loans. 10% debentures. This is debt. Short-term loans, non-current assets, current assets. By adding non-current asset, current assets, you will get total assets. So non-current assets, current assets, 12,60,000. Long-term debt and debentures, 2,40,000 and 6 lakhs. It comes to 8,40,000. 8,40,000. So 12,60,000 by 8,40,000, 1.5 is to 1. So the financial position of the firm is okay, good. The next one, calculate total assets to debt ratio from the following information figures taken from the balance sheet. So total assets to long-term debt, capital, debentures, debt, non-current investment asset, building asset, inventories asset, trade payables, short-term liability, so that current liability, trade receivable asset, general reserve, that is owners, balance of profit and loss account, that is also owners, machinery asset, cash and cash equivalents asset. So only the debentures is liability. Only debentures is liability. Only debentures is liability. So assets, non-current investment, building, inventories, trade receivables, machinery, cash and cash equivalents. So sum of this 42 lakhs 50,000. Long-term debt 9% debentures only. So 15 lakhs. 42 lakhs 50 by 15 lakhs. So 2.83 is to 1. So satisfactory. The firm's financial position is okay. So solvent. Now the last one in solvency ratio, that is proprietary ratio. Proprietary ratio. So here you will take shareholders fund by total assets. We know both the things. Shareholders funds means we have to add capital, reserves and surplus and profit and loss account balance. Then assets means just now we had seen all fixed asset, tangible, intangible assets, investments, non-current investment and loans and advances, current liability. All comes under assets. So by adding all assets and shareholders fund. So now we are, earlier we are seeing how much portion belonging to the outsiders on our total assets. So that is outsiders equity. Now we are going to see the owner's equity. What is the owner's contribution on total assets? On total assets. So if that above 50% our investment, then it is prudent, good. Calculate proprietary ratio from the following information: share capital, owner's contribution, general reserve, shareholders fund, securities premium reserve. So this is also shareholders fund. This, what is securities premium reserve means, at the time of raising the capital, the 10 rupees share if they sold for 12 rupees or 15 rupees. So this excess is called premium. So that is reserve. So they kept that one as a reserve. Profit and loss account. So all this belongs to owners shareholders fund. By adding all this, we will get shareholders fund. Then assets, tangible, intangible, current assets. Tangible asset, intangible asset, and current asset. Everything is given by grouping. At beginning, the owners belonging to the owners, and after that they had given related to assets. Shareholders funds by total. Shareholders fund, share capital, general reserve, share security premium, reserve, balance of profit and loss account. That is 24 lakhs. Then assets, tangible, intangible, current assets. That comes to 28 lakhs. 24 lakhs by 28 lakhs, 0.86 is to 1. Okay, not but that much better. The financial position of the firm is better. Next one, calculate proprietary ratio from the following. See, in earlier case, the denominator numerator is given in the question itself, except current ratio, quick ratio, debt to equity ratio, debt to assets ratio. So now proprietary ratio means here you have to remember total assets to equity, total assets to equity. So share capital, reserves, so only share capital and reserves, it will not come. Comes under owners contribution, that is shareholders contribution. Then the total assets, tangible assets, land and building, intangible assets, patent, trademarks, copyright, and current assets. And current assets. So the sum of all these three. So 18 lakhs, 2 lakhs, and 3 lakhs. By adding these three, you will get total assets. So shareholders funds by total assets. So shareholders funds, share capital, reserve and surplus. So it comes to 13 lakhs. And assets, tangible assets, intangible assets, total trade receivables and others. So it comes to 23 lakhs. 13 lakhs by 23 lakhs, 0.57 is to. Then this is reserves and surplus. So general reserve, debentures redemption reserve, and profit and loss account. If it is kept in bracket, then it's a loss. If it is given in bracket, then it indicates loss. Negative balance. So 5 plus 3, 8, 8 minus 2, 6. So the reserves are 6 lakhs and capital 20 lakhs. 20 plus 6, 26 lakhs. Owners contribution. So shareholders fund is 26 lakhs. Assets, tangible assets 25 lakhs, intangible assets 5 lakhs, and current assets 13 lakhs. 25, 5, 30, 43 lakhs. So the total assets is 43 lakhs. So shareholders fund by total assets, shareholders fund, share capital, reserves and surplus 26 lakhs. Tangible, intangible, current assets is total assets 43 lakhs. 26 by 43, 0.6 is to 1. 0.6 is to 1. Proprietary ratio. Financial position of the firm is satisfactory. So by this we completed all balance sheet ratios related to balance sheet ratios. Now we are going to see the activity ratio. So trading account, profit and loss account, from the variable we are going to see use them. By using them, we are going to check the financial performance of the. So this is performance. So earlier we had seen all financial positions, short-term liquidity and long-term liquidity. So insolvency means the long-term liquidity. Short-term is current assets, current ratio, quick ratio. Now activity ratio. So this is performance. So how many number of times we performed. So that shows our efficiency. So inventory turnover ratio. In this we are having four: inventory turnover ratio, trade receivables ratio, and trade payable turnover ratio, and working capital ratio. So now inventory turnover ratio. Inventory turnover, how many times we purchased and we sold. So that is inventory turnover. So inventory turnover ratio expressed in number of times we turnover, purchased and sold. So cost of revenue from operation by average stock. So if you are familiar with the trading account, then this is very simple. What is trading account? In trading account, opening stock, opening stock, net purchases, and operating expenses. Here net sales, closing stock. So the difference, gross profit. So if we think that it in a profit, now we wanted to know, see, sales means actual expenses incurred plus profit. So from sales, if we subtract gross profit, what we will get? Actual expenses we incurred. So net sales minus gross profit is cost of goods sold or cost of revenue from operation. What is cost of revenue from operation? In the denominator, in numerator, we are showing cost of revenue from operation. What is cost of revenue from operation? Actual cost incurred on the goods or services whatever we provided or sold during that period. So how one can able to find out net sales minus gross profit? Net sales minus gross profit. It's okay, clear. Opening stock, net purchases means purchases minus purchases return, and the expenses whatever you have to show in trading account, operating expenses. Then net sales, closing stock. Net sales means sales minus closing this. Sorry. Sales minus sales return. Sales minus sales return. Then the difference is gross profit. If sales this side is more, and we are assuming credit side is more, debit side is less. So now, what is cost of revenue operation? The first indirect method is net sales minus gross profit is cost of revenue operation. Then what is the other one method? By adding all these three openings. See, depending upon the situation given in the question, we have to find out. So if sales is given and a percentage of gross profit is given from on that sales, if you find out the gross profit, then if you subtract that gross profit from sales, you will get cost of revenue from operation or cost of goods sold. Otherwise, if the sales is not given, gross profit is not given, the remaining information is given: opening stock and net purchases and purchases return. So then you have to subtract purchases return from purchases, then you will get net purchases. Then other operating expenses are given: transportation on purchases, wages, coal, gas, and water, like that. Then you have to add all of them. Then you have to subtract this closing stock. Then you have to subtract the closing stock. Then you will get revenue from operation. Revenue from operation. So one can find with the help of the sales, with the using revenue gross profit rate, or directly opening stock, then net purchases, then expenses, then minus closing stock. Sometimes they will give consumption of material consumed. What is material consumed? Opening stock plus purchases minus closing stock, that is material consumed. So to that material consumed, you have to add expenses. Then you will get cost of revenue. Then you will get cost of revenue. Hope it is clear. So depending on the information available in the cost of revenue from operation, also known as cost of goods sold, is calculated. Cost of revenue from operation, cost of material consumed plus purchases in trade, that is change in inventory. So how to find out? So cost of goods, work in progress rate. So then here one more thing, if it is manufacturing, then we will have the stock in three form: raw material, work in process, and finished goods. So you may SFG, semi-finished goods, finished goods, and raw material. In three form you will find opening stock also in three form and closing stock also in three forms. So if it is given in that way. So revenue from operation, opening inventory, net purchases, direct expenses minus closing stock. So it is clearly understood you. Then cost of revenue from operation minus gross profit. If sales is given, from sales if you subtract gross profit, then we will get revenue from operation. So very simple, this one also. Just the thing, simple thing is to know what is revenue from operation. Then denominator, average stock. Average stock means opening, simple average. Opening stock plus closing stock by 2. Opening stock plus closing stock by 2. Yes, shall we see problem on this? So you may get a very simple problem without any twist. So from the following information, calculate inventory turnover ratio, cost of revenue from operation directly given. Inventory at the beginning, inventory at the end. So cost of revenue from operation is 22 lakhs. Average means 5 lakhs plus 6 lakhs divided by 2. So then you will get average opening, closing by 2, average. Then 22 lakhs by 5 lakh 50,000, 4 times. So 4 times we purchased and sold the goods. Okay. Once in a quarter, for each quarter we are able to sell total lot whatever we purchased. The next one, calculate. It is somewhat clear, somewhat it is expanded. In that earlier one it is given directly, here it is given somewhat in detail. So opening and closing inventory. So for average, purchases, carriage. So cost of goods sold, you have to find out cost of revenue. So opening stock plus purchases plus carriage minus inventory, then you will get the cost of revenue from operation. Cost of revenue from operation. See here, opening inventory, purchases, carriage, minus closing stock. So that is 4 lakh 50,000 cost of revenue from operation. Then average inventory, opening inventory 1 lakh 50,000, closing inventory 2 lakh 10,000, 150 plus 210, 360, 360 divided by 2 means 180. 180 is average inventory. 180, 1 lakh 80,000 average inventory. So 4 lakh 50,000 by 1 lakh 80,000, 2.5 times. 2.5 times. See here, the another situation. Gross profit is 25. In this question, opening inventory, purchases, sales, and gross profit 25% is given. So 25% on sales. See, one should remember, if it may be on sales or it may be on cost of goods sold. Means sales is equal to cost of goods sold plus profit. So if it is on sales means the sales is 100. Cost of goods is so 75. Profit is 25. If it is fixed on cost of goods sold, then cost of goods sold is 100. Profit is 25. Then the sales will become 125. So if gross profit 25% on cost of goods sold is given. 25 by 125 you have to take. Is it clear? I think. So here on sales it is given. On sales it is given on 25 lakh 60,000, 25%. So on 25 lakh 60,000, 25%. So on that you have to find out. Then the closing stock is not given. So you have to find out. So you have to draw the trading account. Earlier the missing is gross profit. Now you are having gross profit. So the missing is closing stock. You are going to arrive that one. Sales, opening stock, opening, opening stock, then purchases and gross profit you will take. So then the difference is you will find closing stock or opening stock plus purchases plus gross profit minus closing sales. Then you will get the closing stock. Then you will get closing stock or you will get cost of goods sold. Cost of goods sold, sales minus 25% from cost of goods sold minus opening stock, purchases, then you will get closing stock. In any way you are able to find out. So sales minus gross profit, gross profit, so the cost of revenue from operation, sales minus gross profit. So gross profit is 25% on 25 lakh 60,000, 6 lakh 40,000, 19 lakhs 20,000. So now you have to find out closing stock. So closing stock is equal to opening inventory, purchases, cost of minus cost of revenue from operation, or cost of revenue from operation minus, then you will get negative value. So ignore that. Cost of revenue from operation minus opening stock and purchases. Minus opening stock and purchases. So that is 4 lakh, 2 lakh. No. Like this is only correct. Opening inventory plus purchases minus cost of revenue from operation. So 2,48,000 is closing stock. So 232 plus 248 by 2. So 2,40,000 is average stock. 1920 by 240. So the 8 times. So it is good. The performance of the firm is good. Calculate inventory turnover ratio. Calculate inventory turnover ratio. So inventory at the beginning, opening stock, purchases, direct expenses, inventory at the end. So administrative expenses, selling and distribution expenses will not take. Sales you will take. So you will prepare a trading account. Sales, then inventory at the beginning, opening stock, purchases, direct expenses, then closing stock. So the difference is gross profit. So that gross profit, if you subtract from sales, you will get cost of goods sold, or sales minus opening stock, purchases, expenses in the bracket minus closing stock. Then you will get cost of goods sold, not sales. Opening stock plus purchases plus expenses minus closing stock. Then you will get cost of goods sold or cost of revenue from operation. Sales minus gross profit, then cost of goods sold. Yes. Cost of revenue from operation. So opening inventory. So here opening inventory, purchases, direct expenses, closing inventory. Then we will get cost of revenue from operation. Cost of revenue from operation. Then average inventory opening plus closing by 2. So that is 3. 8,87,250 by 3 lakhs. So 2.96 times. Very less number of time we sold. So it's not so good. It's not performing well. Next one. So the different situations, total sales, purchases, gross profit, closing inventory, and excess of closing inventory over opening inventory 2 lakhs. Excess of closing inventory over opening inventory. So closing inventory is 2 lakhs more than the opening inventory. Means what 6 lakhs minus 2 lakhs. So how it is given? Just you have to think more than, less than. Uh, so the closing stock is more than excess of opening. So means opening is 2 lakhs less, 6 lakhs minus 2 lakhs, 4 lakhs. Cost of revenue from operations, net sales minus gross profit. Net sales minus gross profit. Net sales is given minus gross profit. So that is 15 lakhs. Then average stock 6 lakhs and 4 lakhs. So closing inventory minus excess of closing inventory over opening inventory. So 6 lakhs minus 2 lakhs, that is 4 lakhs. So 5 lakhs. 15 by 5. So 3 times. It is just 3 times. So by this we completed inventory turnover ratio. Inventory turnover ratio. Still 10 minutes is there. We will see this one also. All these are very simple, easiest. So in case of now debtors receivable ratio. So here the thing is, the denominator where we have taken there average stock. Now you are going to take here average receivables. Average receivables means trade receivables plus bills receivable. Opening trade receivable plus bills receivable closing, or debtors. Trade debtors are simply debtors at the beginning, debtors at the end. Bills receivable at the beginning and bills receivable at the end. So combinedly it is receivable, debtors and bills receivable. Then net credit revenue from operation. So from here, how much we sold on credit. So what is the intention of this? How many times we sold on credit and realized that amount and again we sold. So the turnover of credit sales, where in case of turnover of total sales we had seen there in inventory turnover ratio. Here we are going to see the credit sales, how many times we did during that year. So net credit revenue from operation we are going to find out. So total sales minus cash sales is net revenue from operation. So total sales minus, see, credit revenue from operation means revenue from operation minus cash revenue from operation. So if any sales returns are given, then you have to return minus sales return. Okay, earlier it was debit debtors. Now the changed from the 2013 Companies Act. Instead of debtors, we are going to refer it as a receivables. Replace, say that note in the revised Schedule 3 of the Companies Act 2013, the term debtors has been replaced by the term receivables, which includes both debtors and bills receivable. Therefore, if any question has both debtors and bills receivable, both these should be added to find out the amount of debtors. Higher the ratio, better. So how many number of time we sold and realize it shows that our efficiency of collecting the money quickly. So how many number of times we did that, that is the efficiency of firm. Now calculate trade receivable turnover ratio from the following information: total revenue from operation, cash revenue from operation. So if you subtract from total revenue, cash revenue, then you will get credit revenue. Trade receivables at the beginning of the year, trade receivables at the end of the year, average. So net credit revenue from operation by average trade receivables. So net revenue from operation, total sales minus credit sales 6 lakhs 30. Average opening closing 90 plus 120 by 2 1 lakh 5,000. 1 lakh 5,000. So debtors turnover ratio or receivable turnover ratio is 630 by 156 times. 6 times. Okay, fine. The company is doing well in recovering the debt or realizing the credit sales are done quickly. From the following figures, calculate trade receivable turnover ratio. Total revenue from operations 15 lakhs, cash revenue 20% of this. So 20% is means 80% is credit revenue. So either you have to find out 20% and subtract from 15 lakhs or directly find out 18%, 80%, then that is credit revenue. Total receivables at the beginning, at the end for averaging. So here he did 15 lakhs minus 20% of 15 lakhs, that is 12 lakhs. Or directly you are able to find out 80% of 15 lakhs. Inventory at the beginning and inventory at the, sorry, not inventory, receivables at the beginning, in receivables at the end. Average receivables here. Opening receivables and closing receivables. So 2 lakh 10,000 plus 7 lakh 2 lakh 70,000 by 2 lakh 40,000 average. 12 lakhs divided by 2 lakh 40,000. So total number of times is 5 times we realized the money from our debtors. Here total revenue from operation 24 lakhs. Operating trade receivables 80% of closing trade receivables. Opening trade receivables 80% of closing trade receivables. So here revenue from operation 24 lakhs, cash revenue 25% of the total revenue, and opening trade receivables 80% of closing trade receivables. So net sales, net sales is total sales minus 25% cash sales, that is 18 lakhs. 18 lakhs. Then average receivables, opening and closing receivables. Opening and closing receivables. See here, something is missing in the question. It should be opening trade receivables. Here he has to give that a value 1,60,000 and 80,000 is closing trade receivables of 80% of the closing receivables. Directly I taken here. So 1,60,000 plus 2 lakhs by 2, 1,80,000. Trade receivable ratio is 1 lakh 18 lakhs by 1 lakh 80,000, 10 times it is good. It is good. So in that question, either he has to give the closing or opening, then the difference is 80%. We are going to find out that. So the closing should be given. So the 18% of the 80% of the closing is opening stock. So the closing is 2 lakhs. Okay. The next one, this one also we are able to see. Total revenue from operation 18 lakhs. Cash revenue 3 lakhs you have to minus. Then 15 lakhs is net revenue from operation. Closing trade receivable 15 lakhs. Opening trade receivables is 60,000 less than the closing trade receivable. So like this, you have to give there also. Opening trade receivables is 60% less than the closing trade receivables. So opening trade receivables is less than 60 means 1 lakh 50 minus 60 90 lakhs 90,000 the closing trade receivables. So total revenue, cash revenue, so net revenue closing 90 plus 150. So 90 how we arrive means we know 60 per 60,000 less. So 150 minus 60. So 1 lakh 20. 15 lakhs by 1 lakh 20. 12.5 times. Very good. So the performance of the firm is more efficient in selling their product. So 12 times they sold and realized the money. So by this we completed that receivable turnover ratio. So up to receivable turnover ratio we completed. So okay, we'll have attendance. If you're having any doubt, just you post in the chat box. Yes, is it easy? Are you able to follow? Yes? Oh, 61, 62, 63, 64, 65, 66. Yes, now you ready. After a long time you are attending the class. Hmm? 68, 69, 70, 71, 72, 73, 74, 75, 76, 77.